In this example, we're going to be working with a company that has downstream sales. So we have Perkins Company owning 85% of Sheraton Company. Perkins Company sells merchandise to Sheraton Company at 20% above cost. Now remember that above cost, that's going to be important. So let's go ahead and bold that while we're here. During 2019 and 2020, such sales amounted $450,000 and $486,000 respectively. At the end of each year, Sheraton Company had in its inventory one-third of the amount of goods purchased from Perkins during that year. Assume Perkins uses the cost method to account for its investment in Sheraton. So we're going to highlight that too, because that's going to be important. They would like us to prepare the work paper entries necessary to eliminate the effects of intercompany sales for 2019 and 2020. So one of the things I find difficult about these problems is just keeping track of all the numbers. So we're going to pull them out over here to make sure we have them. So we're going to have the ownership percentage of 85% and our markup of 20%. And remember, that's above cost. Both of those are percentages. Then we also have our 2019 intercompany sales and our 2020 intercompany sales. Those are $450,000 and $486,000 respectively. And these are both downstream. Okay, so we need to do 3 different eliminating entries. I labeled them all as 1A, B, or C because in our class we've been using 1 to represent intercompany transactions specifically before moving on to some different eliminating entries. So the first one is to eliminate any prior year intercompany unrealized profit. And so in this example, 2019 is the first year in which there are intercompany sales that they're reporting to us. So this step will be NA in year 1. However, when we get to the next entry is to eliminate intercompany sales. So remember, our objective here is to pretend as though the sale from one part of the entity to the other part of the entity didn't happen, and instead represent the transaction as the cost that the goods cost when they came into the consolidated entity and the sales price when they exited the consolidated entity, ignoring any transition in between. So during the year, we had our parent company sell to our subsidiary. And when they did so, they would have credited sales in that entry. So to eliminate sales, we are going to debit sales because we want to undo those sales as if they didn't happen. So we're going to debit for $450,000. Then our credit is going to be on the subsidiary side. It doesn't really matter, but just kind of keeping track of what we're doing. Our subsidiary recorded those new items in their inventory as purchases. So we're going to eliminate purchases, and I'm going to put in parentheses cost of goods sold to remind us that this is a line item in our cost of goods sold calculation on our income statement of our consolidation worksheet. Okay, so we've gotten rid of the sales and we've gotten rid of the purchases, sales by the parent, purchases by the subsidiary. And so now our last step is to eliminate any unrealized profit. So remember, profit is going to be realized when the intercompany goods that were sold are sold outside of the consolidated entity. So if we have goods that are still being held by our consolidated entity, that's when it's going at year end, that's when it's going to be a problem. And so that's one piece of information I didn't put over here on our list of key details. They did tell us that Sheraton Company had a third of its inventory, or had in its inventory one-third of the amounts of goods purchased from Perkins during that year at each year end. So our unsold percentage is 33% or 1/3. Okay, so what we need to do is we need to figure out of this $450,000 of sales, how much remained unsold by our subsidiary that purchased the goods and sitting in their inventory. So what we're going to do, this is the situation where it's above cost, the one I don't like. So we're going to break it down into a few steps. So the first one is unsold inventory. So we know that there were sales of 450,000, and of that, 1/3 of that was not sold on outside of the consolidated entity. So 2/3 was, but 1/3 is still sitting in our subsidiaries' inventory. Then we want to figure out what the cost of those goods was to our parent company. So the cost, again, is going to be a kind of funny calculation where we're going to take our unsold inventory and we're going to divide it by 1 plus the markup percentage, which is the 20%. And again, this is specifically because they told us that the markup is 20% above cost. So we're essentially taking our unsold inventory and dividing it by 1.2. So that gives us a cost of $125,000. And so if we take the difference between these two, that would be the profit that our parent company recognized on the sale of these goods to our subsidiary. And so again, that profit can't be recognized until our subsidiary sells the goods on outside of the consolidated entity. So what we're going to want to do is we're going to want to mark our inventory back down to where it would have been had it still been sitting in our parent's inventory and our parent's general ledger. So we're going to take our 12/31 inventory balance and we're going to credit it because we're just looking at our normal balance sheet inventory account right now. And our inventory account on our balance sheet is a normal debit account because it's an asset. So to make it smaller, we're going to credit it by $25,000 to get rid of that profit that our parent recognized on the sale to our subsidiary. Then what we want to do is we want to also mark it down in 12/31 inventory on the income statement to make sure that our cost of goods sold calculation on our income statement, and I should put cost of goods sold here, is accurate and not using an inflated ending balance of inventory in that calculation. And so that's really what keeps us from recognizing that profit in the current year. So then when we get to the next year, now we're assuming that those goods have been sold outside of the consolidated entity. So in general, our book authors assume that no inventory is held for more than 1 year. So if it's in ending inventory last year, it will be sold in the next year. And so when that happens, the first thing we want to do is we want to adjust the beginning balance of inventory in our cost of goods sold calculation. So we're going to credit 1/1 inventory on our income statement. And so what this is doing is it's setting our beginning inventory to the same as the ending inventory from the previous year. So if we adjusted our previous year ending inventory to take this amount out, we also need to adjust our beginning inventory of the next year to take this amount out. But what this does is it makes it so that this profit can now be recognized in the current year. The other place we need to adjust this is in our prior year income statement. And so remember from other sections, when we adjust prior year income statement amounts, the books are closed. And so what we're going to do is we're going to adjust an account here dependent on whether the parent used the cost or the equity method. So this is the first time we're going to use this information. Our subsidiary used the cost method. And so parent amounts for prior years that are under the cost method are always going to be 1/1 retained earnings of the parent. Now, had our parent company been using the equity method, the only thing we would change is this account would instead be investment in S. Something you're going to see in the next example is that we're only using the parent amount here, or the parent account here, because this is income from the parent, not the subsidiary. If it was the subsidiary that originated this transaction, as will be the case in an upstream sale in the next one, then we would have to split this between the parent and the non-controlling interest as we have done in previous examples. Now we can just move on and do our current year sales, and we're going to do them exactly the same as we did last year's. So we're going to debit sales and credit purchases, which is part of cost of goods sold. The amount will be our new sales amount of $486,000. And then we again need to calculate how much inventory is in the ending inventory of our subsidiary, and then how much of that is profit. So the unsold amount is going to be 33% of the 2020 sales. We're then going to calculate the cost, and in this case, it's that above, the markup is 20% above cost. So we're going to figure out cost by using our unsold divided by 1 plus our markup of 20%. So that gives us a cost of $135,000. The difference between these two is going to be our profit, which is $27,000. So again, we're going to take that out of ending inventory on our balance sheet. So we're going to credit to decrease our inventory amount by that markup that our parent did when they sold this inventory to our subsidiary. And then we are also going to take it out of 1231 inventory on our income statement, which is part of our cost of goods sold calculation, to make sure that this amount is not included when we calculate cost of goods sold for the current year. If we were to go on, we would then reverse this amount again for 2021 when this profit could now be recognized.